live trading day
Yep. I'm sorry. Go ahead.
on Friday. So FYI, I don't
Yep.
know if he tests that word.
Well, we had talked about him doing that, and he was adjusting to his new work schedule, and yeah. So and Friday seemed like a day last time I talked to him that could work. Yeah. So let me make sure I got the recording going. Come on, dummy. Yeah.
I think it's recording now.
Yep, there we go.
Okay.
All right, good evening, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for uh, June 8th, 2023. So what we got a couple things to cover tonight. The first one I want to do is take a look at Brian's histogram on a subset of some of his trades. So this is a set of 100 trades. And it's important to note this is the first 100 trades. This is exclusively on DIA on 1 minutes, and then changing to the 3 minute at trade 73. So that would be this set. It might be interesting to check the difference in the stats, because there's probably enough stats on that 23 trades or 27 trades against these 72 to see if there's any statistical difference in there. That might be worth looking at. Okay, and then and it's trading live, only one share, so no position sizing issues. That may be the most important feature of the whole thing. Let me get my view. I can't see you guys here. Let's see. Show. There we are. Yeah. So that may be the most important feature of the test, is that it's forward under live conditions with real money. So you're actually getting your broker's execution. And it's focusing on DIA, not including EWZ. So that's not the whole equity curve, but it's representative of essentially, the one symbol challenge, which is almost like a COTA 2 challenge, although to be fair, you were learning all the patterns. So here's how we read that then. The first, the stat summary. So it's 99 trades, and the single best trade was 7.39, and the worst trade was minus 1.9. You had 52 wins, 46 losses, 1 scratch, so that's a 53 to 46. Oh, let me. I'm getting a little bit of feedback. I'm going to put you guys on mute just for a second. There we go. So a 53 to 46 win rate, and the average win was 1.17. Average loss minus 0.6. If you'll permit me to round that up to 1.2, that's a 50-50 coin flip that pays 2 to 1. Starting on a system that you had never seen before on trade 1. So and then with live trading results going forward, that's pretty important. And you could say the difference, the 53 to 46 win rate pays for the commissions in the future. So it's not, we're rounding it in our favor conservatively in that sense. So that's what I would call the coin flip mental model. If you just reduce the stats to that, what do you get? I'm taking a look at the equity curve. And that's kind of the equity curve you want, that the drawdowns are not painful. There are periods of time when it is grinding, and then periods of surprising payoffs, which is what happens when you get these kinds of trades up in here. Is good things happen to bad people, and you got to be willing to accept the gift. The the average is equal to the expectancy, so that's a 0.34 expectancy. And then the SQN is 2.3, and that's comfortably in the tradable long-term SQN level, according to Van. What's nice is you get a lot of trades, and you get a steady state. So one thing that the next level of doing this, we see it's kind of stabilized around 0.34 in here. What I like to do is add a running 30 trades, and Luke Crawford in Australia he likes doing chunks of 50, which is, I think, good practice also. So what he would do is he would do the same analysis, but every chunk of 50 he would study as a separate set, and then look at the stats of each of those sets, and then see what kind of, at the gross level, the batch level, if I can say it that way, he would be getting. And then he could tell if there was a significant uptick or downtick in performance, it would have a statistically significant batch to work with. I think you get the same effect if you use a running 30 trades. And then what you can do is you can plot the system quality number on that, and then you can get a chart that shows what the seasonality or the stationarity of your system quality number is. And then you can put plus or minus one standard deviation on that as like a control level, and that sort of tells you if you're still generally under control. And by doing that with the running 30, you avoid the problem of large numbers, because what this is sort of typical right in here is that while you're first building out the trade sequence, the individual trades really move the rolling R average around a lot. By the time you get past 30 and up around 50, you get sort of a steady state, because each next trade is moving the average less and less. And so you end up getting an overall system quality number or rolling R average, but you don't get to see, you'll never be able to detect the changing of the tides or the changing of the seasons. So if you go with a running or a rolling 30, you end up seeing you can do that with the system quality number. I also like it with the cumulative R. Although if you do the expectancy, you're doing pretty good. But what the if you do it with the equity curve, and of cumulative R is better, because in theory what you want to do is you want to measure against cumulative R, because that is simply measuring your trade frame, right? So when you set up a trade, and maybe you identified some kind of yellow zone, like if it was on a swing trade, it might have been yesterday's bar, and then you set up a mechanical entry and a mechanical exit. So that's sort of the standard frame. And then you had something like a 2-to-1 to a reasonable target to justify taking the risk. And then what you've got is some dollars per share, which if you buy it with that intention, but it does this, you get a sense of what is that's the architecture. That's how much I have to pay in order to be certain that the hypothesis didn't work. Well, if you traded this one with 100 trades and you were using 1% of portfolio at risk, you're getting progressively larger positions. So the same trade would win more money later. And if your equity curve is going up, it could be simply because your R multiples may be going down, but because the position sizes are larger, you're making more absolute money. And so you can get lured into believing that all is well and you're improving when it's simply that you're taking larger positions on a system that's running out of gas. So by doing the cumulative R, you're normalizing it against the trade frame and the architecture and the geometry of the frame, and then you're seeing what is the R capture versus the R risk, and then that's telling you what your true quality number is, and that's independent of the dollars at risk at some point. So you have a trading machine, some kind of black box with rules, and then you're making a separate decision over here about how much money to put onto each individual trade, but you really want to know what the quality of the frame was, and then that's going to give you a result, and that result is going to come in the form of the R capture, and then it's going to go to your equity curve with specific dollars. So what we want to do is we want to really isolate what is the value of the machine. How is it doing? Now we'll find if there's some upper limit of scalability, like if you start trading at a certain size in some of the smaller caps or the lower volume ETFs, it might be affecting the trade. You might be large enough that it's moving the price around, or you may get bad fills because there's not enough guys on the other side of the trade to give you one constant price. But if you're trading a large caps, of course, that's not going to be an issue. So having the cumulative R is an important one because it's allowing you to examine strictly the system quality number. The portfolio value is something that you like. The equity curve too, because that's what you can spend. But that's why you want to continue to work the cumulative R. The trade sequence plot is an important chart because now you get a chance to see like the seasonality and what was the behavior of the outliers. Like if they all happened in one day and the rest of the 100 trades were terrible, you might, the random appearance of one anomaly day might throw the whole thing off. But this is looking like you've got very consistent risk management all the way through except for that one, and then a reasonable distribution of those fat right tails. So that's good. So I'll look at the histogram next, and the three things I look at, number one is I come out here to the very first thing I look at is any losses greater than -1, and there was, I think, 1. And so we got to fix that. Then the next thing I look at is between -1 and +2. And what I'm looking for in here is something like a normalish looking histogram. I would like to see about 85% of our trades in this region, and I want to see that as positive expectancy. Because what that means is that I have a normal, repeatable, robust process that's earning me money, which is paying me to hang around for phase 3, which is being able to get fat right tails. So in this case, what we have is pretty good risk management in that we're not really experiencing losses greater than 1, but we are open to the possibility of gains better than +2 in a significant way. So the main thing to remember is we got to treat those as the anomalies they are. That's not the expectation, although we're not going to allow it to surprise us that our rule sets will do that. This frequency over here, if I've got most of my trades in this area and it's positive expectancy, that's what keeps me in the game psychologically every day to go to work and follow the rules, take the hit, never get the perfect trade, suffer a little bit, have some bad days at work, but still, I'm going in and putting in an honest day's work. And that's what keeps you true to the rule set. And then every so often, we get a bonus at work, or we find money on the ground. And then as long as we don't get fixated, looking through our lens, as long as we don't get fixated on it as, oh, that's really my system. No, the system was really designed to aim for a 2-to-1 reward to risk, and then be very strict on the risk management, which is why we get out pretty quick, which is why most of these things don't go past 2. That if you had something like a COTA 2 pattern on a really good day, it wouldn't surprise me to see that you had traded something like maybe an SSC, then exited, and then got a COTA 2, and got another COTA 2, and got another COTA 2. If you thought you were the system, and you were expecting this to happen every day, then you might take that first trade, and then you might not get out at those positions. And then the day comes when instead of finding support here and here and here, and allowing you to re-enter in those places, this thing starts collapsing. And then because you're so confident that it's going to be this kind of day, you don't get out, and now all of a sudden an above average win comes back to 0 or worse. And so that'll undermine all your confidence. And so if you're not really strict on the exits, then that ends up destroying your tight discipline in that region of the histogram. So if you do have a system that features those kinds of reentries, though, then what you end up getting is a lot of things like, hey, there's a 0.7 win and a 1.0 and a 1.2 and a 0.5. And so all of those are comfortably inside this little collection of trades here. If you were to add them all up as a single trade, you would say 1.2%, you'd get a 3.4, and now suddenly you got a surprising excellent move out here, and you say, that was really me and my good judgment doing that. So I'm going to trust my intuition now, and I'm not going to take the programmed exits when I'm supposed to. I'm going to start varying the rule sets, and then that's where this solid foundation of trading starts to get undermined. So when I look at the trade sequence plot, that's kind of what I'm looking for too, is what was the distribution of these things that were better than 2R. And there was sort of a comfortable frequency, and they were happening, every so often, almost like a little heartbeat. It might do us well to go back and take a look and see which of those was really contributing to those exceptional trades. And it may be that then what you can look at is say, if the collapsing dragon and the emerging dragon, which is what happens when it comes out of that river and you get an emerging dragon or a collapsing dragon, it has really left the dragon. That should tell you right now that what the dragon is doing and what the RL10 is doing around the dragon is really, really important, because that's where your big wins are happening. So when everything is sideways, the RL10's it. But then when you get that nice breakaway, now you want to start thinking about, hey, I'm looking for the difference between the dragon and the RL10. That becomes the area where those maximum gains are happening. So if you go back and just take a look at these these bigger outliers, you might say, hey, was that happening because I was in a long sideways quiet channel that had become a Z3P and then it broke out and I got an initial really good burst and then maybe I had a bunch of kata 2s right after that in a nice string? Maybe that's what's happening. If so, then you now have you sort of have a sense of what DIA will produce, and now you can start taking a look at other symbols with the same rule set. And it may be that faster moving symbols give you more of these bigger wins, or they happen in clusters. But anyway, what you've got here is sort of a behavioral histogram of DIA with respect to some disciplined rules. So those are just some things that I would look at adding. Is that you want to add a rolling 30. And what matters on that one is on the cumulative R and also the portfolio equity is that if you got like, let's say you had 500 trades on this thing, and here was your zero line, and the first 30 trades you had something like this, you could very easily say in the early days, hey, I'm going to put a plus or minus 1 standard deviation around that as a control measure. And then if I experienced a downturn, then there is some performance level where I can say, right there, this thing is now outside of the control envelope, and now I need to go take a look and see why am I now experiencing this downturn when everything previously was going well? What's causing the abnormal behavior? The abnormal behavior is triggered when your rolling 30 SQN breaks out of that control envelope. Well, that's what happens if you do it on 30. But if now you got really comfortable with this thing and you now had 500 trades, it might be that the envelope is so wide that the amount of distance that you have to give back, this distance from here all the way to the end, it's so far away because it's including the information from so many other trades. But when a change happens in the markets, you end up having some kind of market condition, and then you have some kind of rule set up in here that's it's feeding and feasting off of the market condition. And then if the market changes conditions, but the rule set is staying stable, now suddenly this thing starts underperforming. So if you had a really long period of time in which it was doing really well, the distance you have to go to the control measure to tell you that it broke is unacceptably large. You end up giving up the maximum amount. That's sort of the idea behind like the PSAR accelerates and stays closely connected to the equity curve. So if you do like a 30 period Bollinger Band around the last 30 trades, you're essentially resetting every 30 or 50 trades, and then you can tell quickly if things are going south. And that's why when Luke did his study last year, and also the previous 6, he did about a 6-month study, then a year-long study. He had well over 3,000 trades. So he had, let's see, how many sets of 60? Yeah. So he had 60 sets of 50 trade packages, each one like a chapter in a book. And he could then see what happened in that period, and then what were the big changes set to set. And then he could say, how am I doing out here compared to what I look like way back there? And it was a way that he could start measuring the slow accumulation of professional competence as revealed through statistical significance. You know, it's like taking if you could take a movie of Tiger Woods and his swing, and 3 months apart you could see how his swing still grooved. by taking a look at the sample. So that's what I would add to this, and I think you're in pretty good shape here. So tell me about the feelings of surprise that you had when you did these numbers. This is the first time you did those numbers. And in the future, I'm going to say don't make those orange, because that's going to be hard to read for some people with a small screen. So tell me about the feelings of surprise and the usefulness, and what you think about the process. Yeah,
related to the FFC. Can you hear me? Oh, cool. Well, related to the SFC, I thought I'd been trading it really well, which is really surprising that it's only spat out a 0.1 expectancy. And I also thought I was doing the Z3 really well. And yeah, like it's something I really will start concentrating on to see why I thought I was doing well, as opposed to what the reality was. But look, I really appreciate what you said, Ken. I really thought I was just chugging away at the end of the day. But like when you sort of explained it how you have, I can see how I want to look at it going into the future. So no, it's great.
Yeah, this turns out to be the way that you can actually tease out changes in performance over time. Like if you're a guitar player, you think you're still just the same. But other people that are only coming in and sampling different segments because they're not inside the fishbowl, if you will, they can start seeing real differences in performance. So this is kind of the control charts that you get from an industrial manufacturing point of view. Now, something that we can do with this also, you can actually run Monte Carlo sims on this thing now that you have something like this package here. That actually looks like the marble bag from Dr. Tharp's, marble bag game. You can actually, you could do a Monte Carlo sim with a pull and replace, and then you could run what if 500 trades look like from that distribution, and then run that 10,000 times, and then you end up finding what we would call a straw broom. You'd end up seeing, if I ran 500 trades off of that histogram, and then track the portfolio value, maybe it looked, something like that. And then, so that's iteration number one. And then you run another one, and it did this, and so that becomes pathway number two. Well, when you run 10,000 of those things, you end up getting something like you get sort of like almost like a pachinko thing, and so you end up getting some kind of histogram of the expected value given the frequency and the variation inside there. And so when all that stuff gets kind of filled in, what you'll find is that you end up getting you find the mean, and that's going to be equal to your expectancy, and then your control limits, plus or minus 1 standard deviation, and then maybe plus or minus 2 standard deviations. And then that gives you... Yeah, go ahead.
Sorry, is there any value in going back over the 100 trades and tallying up what you really should have got, like the obvious mistakes that you made, and
sure,
comparing that to the next 100 and doing that? Or have you sort of done that?
You can do that. There's a... the reason to each trade that you take, when you're writing your little notes, you can really make that the learning value now is sort of the perfect SQN.
Yeah.
And that's where, hey, what does the robot get if he did that perfectly? And then what did I get? I, the trader. And then the difference between those is your trader quality number. Because that's going to tell you what the value of your intuition and your skill and your judgment is, your decision making. I had a feeling I needed to take it early, so I did. Now, that's a case where, hey, I had a thing that was going up and I saw the 2 dragon horns, and so I got out here, whereas if I had just let it get out at the Bollinger Band mean or whatever, the PSAR dot or something, the robot would have gotten this, and I, the trader, got that. Well, that difference is not a mistake, but it's a deviation from the pure mechanical rule set. So that would give you something like a plus score on your trader quality number. So if you take that over those 100 trades, you're going to find out what the robot score is, and then you find out what your score is. It's going to be never quite equal. It might be here or it might be there. And then if you analyze this and say, hey, when I didn't follow the rules, I added that much value, you can then state the question, should I keep doing that? If you said, look, my scores were down here after I added all my discretion, I said, okay, clearly stop doing that. Follow the goddamn rules, The extra piece that I would put on here is everyone, the question becomes, how systematic were you in violating the rules? Like if I have a rule set here, and then there's only one circumstance that causes me, and it had to be those 3 conditions, and they're not a rule yet, but because of whatever reason, there was one thing only that caused me to trigger to change. Like the position got too big, and so I took an early exit every time, and that's the only way I ever violated the rules. Well, if you could formulate that, and in your trading journal you had documented why you did that, then you could go back and say, well, in those 100 trades, 11 times I didn't follow the rules, and it turned out that all 11 were from the same reason, and that reason gave me this much extra. I would say you just found and wrote the next rule. And now you put that rule into here, and you find some way to code it and make it part of your formal system, and you're good to go. Hey, but what if I didn't follow the rules 11 times, and the net was positive, but there were 11 different unique circumstances that caused me to change my mind. And then there's some cut line that these were good and those were bad. Well, what's the net of that? If the net was positive and you did it 11 times, you don't have enough information to say, well, I should always follow my intuition because it netted out good. No, because it was only 11, and that's not enough samples. And then you're varying the rule sets 10% of the time. Well, that's a lot of discretion. But what you can do, if you do that analysis, you might say, hey, the ones where I really made a difference, maybe there were only a couple things, and they were similar. Or maybe I took the extra move, on that really nice move, I got out here, but it turned out that the robot, it never came back to where the robot was going to get out, and the robot exit was way up here because the Bollinger Band mean kept going and that thing resumed. And it turns out that my mistake was not to re-enter. Well, that's really good information, because now you get that whole idea of like the series of cotta 2s. Then the thing that I'm missing, I'm not. This is still probably a good idea. Like if that happened 100 times, and 70 times you got out here, and it went down and would have gotten you out there, but 30 times it went higher, it went really way high, and maybe the 30 times it went higher was so good that it was stronger than the 70 times you captured that. You actually have 2 rules now. You just created 2 rules. The first rule is I should always keep getting out here, because 7 times out of 10 I'm getting a better response. And now the next thing I got to do is figure out from this moment, from the time I exit, somewhere in here is a really powerful trade that I'm not getting. And I need to figure out how to do that, because that's really the big trade. So what you said is correct. You want to go, now that you have a trading journal, you can go back. You want to find, these were the results that you got, and then you want to say, this is what the robot would have gotten. This is me. If I identified obvious mistakes where I just didn't understand the rule or I missed it or whatever, it wasn't a matter of judgment. It was just an oversight or span of control or something, just not difference of judgment. So you want to rule those out. This is sort of the perfected you, and now you can compare those two, and now you can get through a really interesting set of analyses about how to make improvements to the robot's rule set. And then you're always just, it's almost like a ratchet. You keep ratcheting up the quality of the rules, making small nudges based on significant sets of data, because that will continue to surprise you. Even on a set of 100, looking at the numbers this way caused you to have you saw the difference between what you felt, what you thought you knew, and what the numbers actually show. So that's why math is a persistent edge. So that's a lot to unpack, but that's really where you want to go. You want to go back and take a look at the errors, correct those, see what the cost of errors were, and then take a look at all the times where your trader's judgment overruled the robot, and then study what the net effect was, and then try to take a look, if you have that in your journal, see if you can attribute it to, why did I make that decision? Can I classify the judgment that I used? If you don't have that information, now you know what your self-coaching needs to contain now, so that you can actually build off that little self-research. It's called first-person action research, where I'm committing in the moment to the thing that actually was my judgment and my memory. Because maybe if you don't do it right then in the moment, maybe you're trading in this case study, and then right here there was an important decision to make, and you had 4 thoughts in your head, 1, 2, 3, 4, and you had different feelings. These were the reasons to do it, these are the reasons not to do it. So you decided to do it, and the result was great. If you waited till the end of the day or the end of the week and went back and tried to say, hey, why did I stay with it? You might, oh yeah, because I knew it was going to be great, and you weren't really remembering all of the things that went into the decision. So at the moment of the decision, as best you can, you want to kind of document that decision before you see what the results are, so that we don't cherry pick, or we don't falsely attribute our reasoning. We make it easier than it really was. That may have been a really strong battle, but if you only remember the good reasons why you did it when it paid off, then it's sort of a false memory. Right? So that's what I wanted to say about that.
I've got one. Sorry, I've got one question about tweaking the rules. After like doing the analysis and tweaking the rules. Like
Yep.
this was done under a quite full market. Like if I give the rule to tweak now, and we go into, let's just say we go into a bear market. Have I moved away from what you've taught me, or and am I going to cop on that black eye because I've changed?
Well, that's one of the reasons why we wanted why we want to get 50 trades
And do it in blocks, right?
Yeah, and then what the other thing you can do is you can then say the time period that this occurred. I can go back and take a look at SPY, or DIA, whatever, but maybe SPY, and then just say, hey, that was this was all in an emerging bull. Maybe there was a little bit of sideways in there, but in the market classification, this data set is coming from out of that little target array, right? And then you can start attributing this performance to that kind of market condition. And now you're getting the market, sector, and target. Now, in this case, the difference between DIA and SPY is pretty small. So what you're really doing is you're able to kind of concentrate on that. You say, when the DIA is in that market condition, these are the results I got. Now, that's a really useful statement to make because it is carefully demarked or limited to just the data set that got it. So the market was doing this, and this data set is taken from this period of time, and that little stream, when the market looked like that, I got these numbers. Hey, if that thing rolls over and now it's in the fall, and the market did this, but my numbers were even better, why would I not be surprised on that? Oh, because you're going to see a lot more collapsing dragons in there. So now that you know this, you can say, hey, my best performing signal in a young rising bull market was the collapsing dragon failure pattern. What an interesting and useful piece of information that is. I wouldn't be surprised if you found that in a bear market, the emerging dragon was the surprising move. It could happen. My experience is that the collapsing dragon is good in a bull and it's brilliant in a bear because it's easy. And that's because greed climbs the stairs and fear jumps out the window. And that's what the collapsing dragon does. But that's sort of the next level up, is you can now take a look at the instrument you're trading and then compare that to the market. Now imagine that you had 10 symbols and you were doing this with your hybrid swing patterns, right? And you had 10 different targets. Maybe I have 10 targets and 5 different patterns. So I have a total like 50 different segments or categories of trades. And I did 300 trades of all of those based on the frequency. And I came up with sets of 50, 6 sets of 50. What I'm really doing is looking at the meta system. I'm really looking at a complex system of 10 different things that behave in certain ways and 5 different patterns. This is really a meta system that maybe gets a lot of trades in a short period of time. And now I can still do this little set, but if I have a standard habit way of behaving, whatever the sequence is, then what happens is that when the market goes through different changes, you get a different frequency of which patterns are working. And so that almost is a self-correcting, you get more patterns of the kind that are working when the market moves that way. But you only know that if you compare your performance of many symbols against the broad market. The reason I ask you in Kata 2 to look at DIA versus EWZ is that DIA is very strongly correlated to SPY, and it's a great big fat symbol that is a collection of the integration of 30 large caps from different business sectors. So it already is an integration of a wide variety, but you're only trading one. So it has a simplified blended return in that sense, which is why it's an attractive target. Now, EWZ is correlated to the S&P, but less correlated and greater volatility. And so when you do the COTA 2 challenge on DIA and on EWZ, you're getting a real sense of just how different that rule set can be compared to the S&P based on that conservative symbol and this global emerging market symbol. And then that's very different than looking at individual large cap companies themselves, or even a blend of large cap companies, or 5 different patterns inside this family of patterns with 20 different symbols. You can quickly see that if you don't cut your teeth in learning how to do this kind of analysis on a very controlled set of trades on one target, one pattern, that kind of stuff, you can quickly make some statistical errors in what kind of conclusions you're allowed to. And your record keeping is so much harder. It's much better to find out which of those 5 patterns really work for you under control, and then add more symbols and only take the patterns that work for you and see how that goes. It's much easier to scale from a simple base than it is trying to start with a really complex system of 10 symbols times 5 different patterns in every market condition over different time frames. You can never really unpack all that. But what you can is you can actually at some point say, look, I've got this aggregate strategy, this collection of meta systems, and I'm using my trader judgment about which ones to pick and choose. And it turns out that for the ones that I picked, if the robot scored this and I scored that, the difference between the robot's SQN and my SQN is what I call the TQN. That's the difference that my judgment makes. If it's a positive effect, then you should do more of that in guided, professional, systematic decision making about when to add a new symbol, when not to add a symbol, that kind of stuff. Which pattern to take among all of them. And you can see me suffering through that all the time on the nightly hybrid swing, as I beat myself up all the time, like, why am I not trading that other symbol? Why am I still trading this symbol? Or why can't I get into that pattern? The pattern is clear, but I couldn't take it. Was it a psychological bias? Was it span of control? Was it, ran out of capital? Or what was just a feeling I had? I had something bad for breakfast and I had a bad feeling. So this is the pathway. This is what we mean by the importance of assessment. So when you think about plan, prepare, execute ruthlessly, and then assess, the plan, that's, everybody worries about, that's the least important one of those. That's the easiest thing in the world to do, is to come up with a simple enough plan that gives you an opportunity. It's the preparation. The harder work you do in preparation, the better chances you have of following the rules exactly, because you've anticipated the judgments and you're not pulled away by an impulsive action from lack of preparation. If you don't prepare, you have to wing it if you're going to trade. But if you want to be a trader and you didn't do enough prep, the chances that you would then not trade because you realized, I didn't do my homework, so I'm just going to wing it. That's amazing. To have the discipline to not trade when you want to trade and you recognize that you hadn't prepared, that's a major leap forward. But the more likely, reliable behavior is I'm going to over prepare. I'm going to have a simple plan and then over prepare. And then when it comes time to execution, the amount of surprise that I have is reduced, that I've foreseen all the things that end up happening, and I could just execute according to the way I rehearsed in both directions. And then it's easy to assess because there are going to be fewer cases where I use my trader judgment. I'm really able to evaluate the robot's rules. And then I can go back to the prep and go back to the planning and the rule set, and I can use the assessment to improve all those. But if it turns out that I was not well prepared, or the market was crazy, or I wasn't following my rules, now my assessment should help me figure out, oh yeah, what I got to work on here is psychology. It's not the rule set. The rule set did fine, said the robot. But my performance, attributed to psychology, tells me that that's where I need to do the work. So, compared to assessment and compared to preparation, execution is easy. That's pushing a button. Planning is easy. It's just making a list. And then assessment, if you do it right, is as hard or harder than preparation. And looked at it in the correct way, assessment actually is preparation, because that's the preparation you're doing on understanding what you did, and then that's followed by the forward-looking preparation for what you're going to do. You'll realize that it's the same mindset that guides you through your preparation is also guiding you through assessment. That's where the professionalism, that's the little bridge through the subconscious in here. That's the professional linkage. The professional connection between assessment and preparation. That's the professional mind at work. When you know that you've done that, when you are the living sword, it's actually not even a decision that you make to follow your rules, because you end up seeing yourself following your rules without even thinking. You had just did it because it was the right. You say, "Oh, I just did that," without even thinking. That's actually when you are one with the sword. That's the way of the living sword. Now, am I going to gig you if no? I thought about it and I follow my rule. That's okay too. That's just the that's your confidence. That's your conscious confidence in your professionalism, leading you to take the correct action. So if you take a look at the well-known chart that says competence, yes or no, and then conscious, yes or no, there's some moment of unconscious incompetence. I'm bad and I don't even know it. And then I become conscious of how bad I am. That's actually a movement, because you went from being unaware to aware of how bad you are. And then you implemented some rules and discipline, and then you go to conscious competence. That's the next step, where you have to think about it. I have to say, hey, I had a choice to make, to follow my rules, which are well prepared, or to follow my instinct, and I elected to go with my rules. And then later on, I will assess to determine if that impulse that I had is actually a good one. That's what the conscious professional does. And then when you do that enough, the knowledge of your feet carries you into the unconscious competence, where you're automatically doing the right thing because you've overtrained it, and you're not even, it's not even a, you just do that because you know that's what, you're trusting your hands and feet in soccer. So this is where that walking man also comes around too, is you got to use all of those little guys. The knowledge of your head is sort of the rational, analytical process that I've just described here. The knowledge of your heart is remembering why you're doing all the hard work. It's because of your vision and the people that you're serving, your commitment to service to them. That's why you're doing that work. That knowledge of your heart is where you're finding the energy to do the harder right thing. And then it's the fear center or the greed center in your gut that is the trigger for impulsive actions for fear and greed, which is the same thing. It's fear. Greed is nothing more than fear of missing out of a good thing. Fear says there's so many bad things that happen in the world, and most of the time it's bad. That's where the fear comes from. But then the few times that you notice it goes really well, you realize, man, if I don't get all of it when it's in my favor, I'm missing the chance to really cash in. So fear of missing out is what greed really means. It's a healthy greed. It says, I recognize the world is a tough place. So we got to come to that understanding and recognize the fear for what it is, which is a signal which says I got to do some work and some thinking. And then the knowledge of your hands is the specific knowledge that it takes case by case, trade by trade, to develop the conscious competence that moves you up into this one where I have an approved set of rules approved by my head that I know that I can execute when I am disciplined and think about it. I can execute it with my hands. Now I'm in the area of conscious competence, but I want to get to the point where I am the living sword, and I have to become unconsciously competent. And that's where the knowledge of the feet happens, is that I've done it so many times on this journey that my feet just automatically take the next step properly and moves me into the right position where the automatic skill in my hands takes over. That my fear puts me into the right place for opportunity and protection against danger, and then my hands and feet working together allow me to execute my battle drills, and it's all in support of my heart. And then I just have to keep my head busy so that I stop overthinking it. How do you do that? By doing this kind of work. Give that work to your head. That's what your head does really well. And when your head is busy working on that, it has less of a tendency to come down and monkey around with your hands and feet. It trusts the ball. It trusts your feet. Right? So that's sort of the mindset we want to get to. Check or hold?
Yep, check. And thank you.
Man, that was top shelf. That's what
I
that
really
was.
appreciate it.
That's what that was. That was actually top shelf. All right, Damien. Everything that I just said was kind of with this in mind.
I noticed that. I thought you were talking to me when you were talking to
I was.
Brian.
I was. It's the same thing.
It is. It is. It is.
Yeah. Greg makes a good point. I noticed his max excursion to R capture. That's another reason to analyze the charts after you've done that, because there's no reason to believe that the rule set that we have actually hammered out is actually the best rule set for the kinds of moves that the market is giving. And that's where, if I think I have one in there called the Trade Index Analyzer. And in that lesson, what you do is you take each trade. This works better for swing trades. But on the swing trade, I entered here, and I had my stop here for 1R. And I had my little 2R target up in here. And So that's my 0 line. And then I got that trade result. Well, this is what I captured. But I can now, if we call that time t, I now go out to time 2t and find what was the maximum, what was the max price in the 2t time period, and what was the min price in the 2t time period. And then if I set that equal to 100 and that equal to 0, I can now tell you in that 2t period, where was my entry on that scale of 0 to 100? And where was my exit on that scale of 0 to 100? And if that was at 60 and my entry was at 40, I captured 20% of the move that was reasonably available from the moment that I entered to if I had just stayed a little bit longer, however long I was in that trade. If I was in that trade for 3 days, I go out to another 3 days and say within the 6-day period, here was the max and the min. And then what you'll do is you'll find out, once you start mapping those trades out, you say, hey, there's a ton of move that happened higher than where I got out. And it was twice the size of what I actually captured. Now suddenly that positive expectancy system makes me feel like I'm wasting it. And then you can say, did the maximum price occur in the T or in the, before or after I got out? If it happened predominantly before you got out, then you know that your exit rule is giving back too much. If it happens after you're exiting, then you're missing maybe a re-entry rule. If your trade index, I had one in the 5DD where I was entering at 60 and capturing 70, and I thought I was doing good because I had a system quality number of 4. And what was happening was there was a huge follow-on moves. I had reasonable exits. I wasn't giving back too much. But the biggest move was not the re-entry that I was missing, but all of the failures of the original signal that I wasn't even taking at all. So when you think about max excursion, you can now take every single one of your swing. It's harder to do intraday. You can do it intraday, but it's a real pain in the ass. But swing trades are better. I have a spreadsheet that allows us to do that, where it says it calculates. You tell me all you got to do is tell me the day you entered, the price you paid, the date you exited, and the price you got. And then the spreadsheet will calculate the 2T, the max, the min, assign all the index values, and then it'll map out and show you what your R capture was. And then it'll tell you, so I started doing that about 20 years ago, and what that helped me do was refine my profit preservation of the best moves in the T time period. How much was I giving back? And then it helped me realize that I needed a re-entry, the COTA 2 re-entry, because I was just missing so many good trades. I would get one good washout pattern and exit, and then miss all of the COTA 2s, 6 or 7 more trades. And so while I captured this little piece, I was missing huge amounts of simple continuation patterns. And then but the real eye opener was the failure pattern. And that was what led to the collapsing dragon. Because I went back and studied all the ones where I just missed the most. I said, what was the pattern? What should I have been seeing? And that's where I realized this pattern right here. 1, 2, 3. When that has rolled over and I get this move here, the collapsing dragon, led me to this idea of the in the pocket and entering in this section after it rolls over. And if there was a harsh winter here, and this gives me a measured lower high, I can get into this all day. And then if it fails through the previous low, which was the pinpoint precision of where the R10, which is where the PSAR flips at, when this rolls over, if I can enter short in the pocket and then it breaks through the collapsing dragon, I can use the money that I made here to fund the second position in the collapsing dragon, and I don't have to worry about a bad fill as much because the money that I've already made pays for that slippage. And then because we're triggering off the peak of the lowest part of the RL10, there's another price bar down here where the maximum excursion of price doesn't even hit to here. And as long as I trigger on the collapsing dragon, I still have that little region before the real explosion down occurs here. The real explosion occurs when a new low is made. That's hugely important. So yeah, to Greg's point, the max excursion to the R capture, that's what we mean by the trade index analyzer. There's a really good video with the spreadsheet sample on there. That one's really pretty good. Damien, I want you to listen to everything that I said on this one again. And I'm gonna agree with you that the things that you've identified look to me to be the things that would reasonably work. I'm not going to tell you not to do what you think you should do. It doesn't violate my sense of what seems right. Hey, I'm using Navage, that little nose irrigator, the sinus cleaner and all that stuff. I like it. It's helping me sleep a little better.
Yeah, but I have.
You probably have.
To make
stuff.
a long story short, I have a CPAP machine that hasn't been working correctly, and because of everything being back ordered, I've been waiting for a new one for a year and a half. Because
I'm actually looked. I bought a Navage, and I don't like the way that it makes you load that little salt packet just exactly so before it works. That's pissing me off. So I'm looking at some other things that don't need so much kindness and attention. But all these things here, the walking and the meditating, and listen to the Master Shi and the 5 hindrances,
Okay.
and climbing the mountain, the 5 things that you're going to encounter on the way to the top of the mountain. Master Shi, that's the guy. Listen to that while you're walking and breathing and meditating. And then the 10 ox herding pictures. That is in the same tradition as Master
I was
Shi.
thinking, and I haven't taken action yet. Maybe I'm doing the spy. Maybe I should start trading the DIA.
I would try that. It's slower and smoother. Yeah. DIA is slower and smoother and more reliable. And by the way, one of the things you'll notice is that when the SPY turns, trigger, now go look at DIA, it may only have been in a doji. And then when you see SPY taken off, you can frame that one tight because you know it's going to follow. That can be 1 to 3 minutes slower after a confirmed move in SPY. That can happen. And you can get a really tight risk box in here. So I wouldn't neglect that. I'd have my chart set up so you have the SPY here as the foundation and then DIA here. And then you can see when this turns and this is in a doji, get ready. By the same token, DIA may be going up and the SPY just peaked. That's the time to really make sure you've got your stop in. But sometimes when the SPY gives you that little kata 2, this thing never even flinches and just keeps going. That can happen. So study those two. All right, that's it. I have a
One
28.
of the things that
Oh, go ahead, real quick, because I got to get the other reports done too. But yeah.
No, I was going to say what saved me this week is I'm only trading one share, so the damage is not monetary; it's all psychology. You know.
Yeah,
That's
except
the
that the
thing.
fact that you have real money on it means you cannot hide, and it actually feels.
Yeah.
It hurts as much as if you had 1,000 shares on it, emotionally.
Yeah,
But it doesn't
does.
hurt as much financially. So that's the other reason to
know.
trade one share live.
So
Right.
I'm going to let you go because
Yeah.
I know you have to get ready for the next class, and I'll see you there.
Yeah.
Thank you.
So listen
Take
to that
care,
first
guys.
section. Listen to that first section again, and then Greg, you and Brian take a look at that. Find that trade index analyzer in the foundations course, and listen to that. And that's really effective for swing trades because I have the spreadsheet for that. I haven't built the one to do the intraday. It can be done with the same principle, but to me, it's more effective as a swing trade rule analyzer. So there we are. We'll see you shortly. And Greg, if you go to that other one, if you don't mind telling them at 8:45 probably, I'd appreciate that. Thanks.
Thank you, Keith.
Yep.